All right, good morning, everyone, and welcome. My name is John Zanadio. I'm the Executive Director of the New Jersey Association of Counties, and I'm very happy that you are joining us today for our series of workshops. This week it is on crisis budgeting and forecasting for county governments. We put together just a tremendous panel that I'll introduce to you shortly, but before I do that, a couple of housekeeping things. Well, really one thing is that if you do have a question throughout the course of the workshop, which will run from 10 to 11, but we'll probably go a little bit over, knowing the three guys on this panel and all the good things that they have to share with us. Please use the question and answer icon, not the chat room. The chat room is for the panelists to communicate with each other, but you got to use the question and answer icon on the bottom of your screen. At this time, I'd like to introduce, and first I'd like to thank our sponsors, Investors Bank and Asphalt Paving Systems, for their support and their continued support of the New Jersey Association of Counties. And we're going to give them each a minute or so to showcase their outstanding businesses. And we're going to start first with our friends from Investors Bank. I'm sorry, Brian Toronto couldn't join us today, but we're very happy to have you here, Max, today. So the floor is yours, Max.
Right. Thank you, John. Brian will join us a little bit later. Good morning, everyone. Investors Bank, we're really honored to support the New Jersey Association of Counties. Investors Bank is one of the largest banks headquartered right here in New Jersey. We're out of New Jersey with over 50 branches across the New York and New Jersey territories. We are a full-service commercial bank. We're specialized in personal banking, business banking, and of course, government banking. Investors Bank holds the #1 spot for government deposits in the state of New Jersey. And we very much appreciate the opportunities and support from all of our New Jersey counties. So thank you. We do have excellent relationship managers, decades of experience in the government banking industry. Brian Toronto covers our Northern New Jersey market. Joseph Setti covers our Central and South New Jersey markets. And again, just on behalf of Investors Bank, Brian, Joe, myself, thank you for allowing us to participate in this event. We do look forward to seeing everyone next year, but certainly in person and over a drink or two. And with that said, I just want to wish everyone a great day, stay safe, and back to you, John. Thank you.
Great, thank you, Max. I appreciate it, and you've got a terrific team there with you and Joe and Brian. And the one thing I do want to mention and thank Investors Bank for their just continued corporate generosity in awarding the NJAC Foundation, which is a part of the Association of Counties, over $250,000 in scholarships for county vocational technical school students who are continuing their education right here in the state of New Jersey. Over the past, I'd say 10 years or so, the Investors Bank has been kind enough to donate that money to the foundation, of which we then give 100% of that money away again to county vocational technical school graduates. So again, thank you for that and your continued support, Max. We appreciate it a great deal.
Thank you, John.
And next up, I see Walter Percy from our friends at Asphalt Paving Systems has joined us. Walter, I'm glad you could be here, and the floor is yours, Walter.
Hi, there we are. I'd like to start off by saying thank you to NJAC for the opportunity. My name is Walter Percy with Asphalt Paving Systems. We are a liquid asphalt manufacturer and road construction contractor that specializes in pavement preservation. What is pavement preservation? Pavement preservation is applying wearing courses over top of existing pavement to extend its life and restore it to a good condition before it reaches the point of costly rehabilitation. We target roads that are in fair condition, typically roads that are 6 to 7 years old and are just starting to show signs of wear, oxidation, minor cracking networks. The wearing courses are thin lift applications that average about 3/8 of an inch thick. These include microsurfacing, slurry seal, chip seal, cape seals. A lot of this work going on all across the state of New Jersey on municipal level, state DOT level, By applying these products to your roadways, you will extend the life of the original asset by 6 to 8 years. These are much cheaper options when you put them up against milling and paving. What we try to do is look at the agency's overall road network as a whole. Recent customer of ours, the agency has 260 miles of roadway. When asked how many miles of road do they pave each year, the engineer says, we do about 5 miles a year. At that rate, it would take 52 years to pave every road in the town. So obviously, it is not a feasible plan. So we try to increase the lane miles using these products each year to really increase the amount of roads that are touched within the agency per year. Again, these are much cheaper options up against milling and paving. We all know with all the budget uncertainty, often road work is the first thing on the chopping block. These processes offer alternative paving options at a much cheaper price. The wearing courses discussed are all heavily backed by the New Jersey Department of Transportation as well as the Federal Highway Administration. We started with the DOT with a pilot program about 13 years ago. Each year, the DOT has increased their investment. Now they don't spend less than $100 million a year on pavement preservation. They have the data that shows that overall we've improved the state's highway network by 35% by implementing these paving processes to their plan. Treasury contracts are in place, which makes purchasing easy. For additional information, you can find my contact information on our website at asphaltpavingsystems.com. We offer help with road reviews, schedule site visits to see the work being performed in your area, all that good stuff. So I appreciate your time. Thank you.
Great, thank you, Walter. I appreciate your support, and hopefully you'll stick around for a terrific panel. And I am very pleased to introduce our 3 speakers today. I can tell you that probably more than anyone else in government, and even more than my family, I probably spent more time on the phone and on video conferences with our 3 panelists than anyone else, with all the legislation and local finance notice and other regulations and directives that have been flying for the past year. And I've just learned a tremendous amount, over the years from these three gentlemen. So it's a pleasure for me to introduce them. And I can tell you just work like our other panelists in other workshops, just day in and day out. And I'll start with John Reinhardt, who is the immediate past president of the Government Finance Officer and also Chief Financial Officer of the Borough of Wharton. John is just a brilliant finance officer who I rely on a great deal on finance matters. And I will tell you, I don't think he sleeps. I get emails from John at 2 or 3 o'clock in the morning, and I better answer them or I'm in trouble. So, John, thank you for being here. I appreciate it a great deal. And the same can be said for Jerry Zaneski, just a seasoned, veteran, grizzled finance officer. And the thing that I love the most about Jerry is that you know exactly how he feels, and he's usually right. So Jerry, thank you for all your support and help and guidance over the years, and for taking the time out of, I know, a hectic schedule, being here today. And certainly not last is Joe Lupino. In addition to being an outstanding finance officer in Bergen County, he makes outstanding homemade red wine. Fantastic. And Joe, I told you I wouldn't forget the bacalao. Bacalao is great. It's great too. For those of you who know what that is, Joe, it's fantastic. But and Jerry, by the way, is the current president of the GFOA and also Cumberland County Finance Officer. So I neglected to include that. So, gentlemen, the show is yours. Thank you again for doing this today. I appreciate it.
Okay, I guess I'll again, John. I want to thank you again for for inviting me on the panel and to be part of this outstanding panel to talk about current events, hot topics, and budgeting. And I want to welcome everyone Here, good morning. I know a lot of you are, going through a lot between CARES and COVID and putting together your budget. And so just to take an hour, I hope this could be very informative for you. Again, we're going to pick a top-level approach to current budget strategies and the hot topics. So our first area, let's go to the area of discussion, Angela. Our first is we're going to talk about year-end revenue planning and fund balance management and that local finance 2020-24, which is the deficit finance, the CARB bonds that will help, which I think is a great tool to help us stabilize our fund balance. We'll also be talking about cash flow and strategies, the bond market, what's going on. That will tie into our local finance notice about issuing the notes that are available. And also we'll get into what's going on with CARES, FEMA, and the election funding, the election grants. So why don't we start with our first slide, Angela. Okay, so again, the pandemic has taught us that fund balance and reserve is paramount to surviving. I think the best analogy to fund balance is pitching in baseball. The great Joe Torre said, "You never have enough pitching." In local government, I think this pandemic has taught us you never have enough fund balance. So right now, we were at the end of the year, so the CFO and the administrator should be working hand in hand together, projecting out the county revenues and developing strategies to augment the fund balance before the end of the year. Again, I think every county has experienced revenue losses, so it's very paramount that we kind of keep an eye on the fund balance at the end of the year. Some strategies that I do, again, these are my strategies, and I know, John, maybe you can chime in on your end, and Jerry. Again, since we are going to experience some revenue losses, look at maybe some old contracts or accounts payables that could be canceled by resolution to augment your fund balance. Again, this is a little tricky. 2020 appropriations, if you have CARES or FEMA credits that by redirecting some employees, and like for example, at the county, our sheriff, the courts have been closed, so we redirected our sheriff's officers to handle security at various testing sites in Bergen County. And that is CARES eligible credits. So those credits are going to go back into the sheriff's budget, and it's going to create, some open balances, of course. So again, there is opportunities to maybe cancel before the end of the year. You have to do it by resolution, obviously. But I know, John, you had some concerns about that. Some concerns, John. Why don't you chime in?
We do, and I think, for all the CFOs out there, we know that if you start to scrape out your 2020 appropriations, that just starves what comes back to operations in 2021. So you might get it today, but you're giving it up for tomorrow. So I think that just needs to be kept in the back of your mind as you're scraping these appropriations, and whether or not you do that or take advantage of the new CARB bonds that are out there.
Yeah, exactly. Again, the important thing is to have a plan. And again, I know John and Jerry and myself, but most CFOs, when you put together a budget, it's a long term. You're putting together this year's budget, but you have an eye on 2021, 2022, and 2023, because what you do to one budget, what you do to your 20 or 21 budget affects the next two budgets directly. So just keep that in mind.
If I can jump in on the plan.
Yeah, Jerry.
I mean, our rating agencies have for many, many years insisted that we have a policy on fund balance. So hopefully we all do. I mean, I've always had a plan. Back in 2014, actually, you put that in writing, and Standard & Poor's said, we'll see if you can stick with that. We did. I mean, this is a rainy day fund balance. It's raining out. And it seems to rain pretty hard about every 10 years. So if you can codify a plan on how you're going to sustain fund balance over the long term, and when it rains, we need to work on replenishing that fund balance. As I forget if it was John or Joe mentioned, John mentioned, canceling appropriations now will, help you now, but you need to recoup that in the following year in some way in your plan. As we project our fund balance and determine how much we're going to use in any given budget year, we have a 2-year budget cycle. So when we're adopting our budget, we know what expenses are going to roll into fund balance and try to best predict your revenues and plan for the rainy days.
Exactly. Yeah. Again, like I said, I think the moral of the story is, you got to have a plan, and you've got to be long-term looking at it, and there's not a right or wrong answer, but you have to know you have to know your plan. Another tool is the Storm Recovery Trust Fund, which the director gave us permission beginning of the year when the pandemic happened, that we could use. Hopefully everyone has a storm recovery fund. It's a Chapter 159. I'm sorry, a dedication by rider that you do. Again, that's just a reserve there, and we can use it for COVID-19. Again, if this, if this which it seems like it's not leaving anytime soon. And when the CARES, I guess, we're approaching the CARES deadline. Again, if you have, so that those CARES funds may have to be returned by the end of the year. But again, if you have a storm recovery fund, you can use those reserves to offset some CARES costs. That is allowable by the director. All right, why don't we go on to the next slide, Angela? Again, we're going to be talking, this local finance notice 2024, it's basically it empowers local governments to alleviate the financial impacts of COVID. It's a tool. It allows, and basically if you read through the local finance, it allows the governments to authorize a special emergency to COVID-related expenses, financed by special emergency notes. Again, I'm not sure most counties need to do expenses because a lot of the counties did receive, or everyone is going to receive some form of CARES funding, and we'll go over that later.
Well, Joe, if I can comment on that, we did an emergency back in the spring, because we all know you need authorization to spend, and the grants kind of come in after the fact. In a couple of slides, we'll talk about tracking expenses, but by setting up that emergency, it puts it in a single pot, single pool. And then what we're able to do is reduce the expenditures in the emergencies as the grants come up, and basically reclassify them into the grants as they come up. So we have a pot of money there as kind of a clearing account waiting for the grants that are now starting to come through. Yeah,
that's an excellent point. I mean, hopefully everyone did that. We did that at Bergen. Again, charging instead of hitting your line items, because everyone's line items are very tight. And there is a lag between getting, especially from FEMA, getting reimbursements. But that's
Joe, before you move on too, I think it's important to note that the Local Finance Notice 24 came about. It originally started off as Assembly Bill 3971 and Senate Bill 2475, of which three of us were very active in testifying on. Unfortunately, those bills passed both the Assembly and the Senate, and it received the conditional veto from the governor within, I think, less than 24 hours. Mm-hmm. John Donadio would probably have that better. Actually, it was less than 24 hours. It was a record signing of a conditional veto that really gave us almost essentially the same thing that we were looking for in those bills, except it added a lot more oversight from the division.
Mm-hmm. Yeah,
and a little bit more restriction on us.
Exactly. Yeah. So again, I want to mention in going into that, diving into that, into the local finance for the special emergency. And again, we didn't talk about, besides the expenses, is also loss of revenue. We'll get into that also. The special emergency related to any expenses or loss of revenue The local unit calculates a 3-year average on revenue, and you have to use 2017, 18, and 19. And again, this is on the COVID affected revenues. And you got to compare that average, that 3-year average, to your actual, to your revenue projected in cash, and on a cash basis. So that's an important, but also, again, keep in mind, and I think at one of the conference at the GFOA, the director also mentioned that for 2021, the anticipated revenues in your budget, there is a 3-year averaging, but you need to use 2020, 19, and 18. So a little bit of a difference. So basically your budgeted revenues are probably going to be a little bit less than doing the calculation, using the 17, 18, and 19. So just be cognizant of those 3-year averaging, the two different.
Which is also interesting because we all know that if your CFO is able to certify that you're going to receive a higher revenue for any reason, you can still exceed the 3-year average and anticipate what you think you're really going to get.
That's a good point, John. All right, Ange, let's go to the next slide. Okay, so year end, again, we mentioned this local finance allows governments to issue deficit finance, special emergency notes, the spread, and this is where the spread of loss of revenue and operating deficits as a deferred charge over subsequent year, rather than take the budget fully in the current year or next year. This tool will help you, and I have an example. This tool will help you stabilize your fund balance. The mechanics of this, the CFO, the CFO has to make a written application to the director, and there is a prescribed form on the website. And again, key dates, you need to have that in to the director by December 1st. And then the director has 45 days to approve that. And per the form, the CFO has to certify, and this is where the CFO certifies the 3-year revenue. He or she has to project the actual collection based on, I'm forecasting based on my 10 months that I have. I'm preparing that right now. So I'm forecasting the next 2 months.
So Joe, let's go back to the third bullet for just a second.
Sure.
So that means if our deadline is December 1st and the director has 45 days, you may not get your approval or denial until January 15th. Your year is done.
Right.
So I think we're all recommending that you act a lot sooner so that you've got some reaction time if you have to resubmit or if they're seeking some
exactly. That's a great point. I know I'm putting it together. I'm hoping to get my application in by November 4th. That's my goal.
Yeah. It requires a freeholder act.
Freeholder. So it requires the certification has to go to the freeholders and they have to approve it. So
we're looking at mid-November in my case to get it in. But
to get it in.
Yeah, it's essentially becomes a closing adjustment to your fund balance, so it doesn't really disturb you that much. The bigger concern I have is the appropriation side, the spending side, and we'll get to that in a second.
Okay. On the form, also there is the CFO needs to disclose the deficit attributable to COVID-19, if that's applicable, any itemized COVID appropriations included in the emergency, if applicable. And also there is a narrative there, the last page or the last tab, it's a fiscal and operational measures what is your county doing to implement and to avoid any structural deficit in the future budget years. So there is a narrative, so be prepared to put something together. Again, it goes back to having a plan. Okay. Let's go on to the next one, Angela. Okay. Okay, Jerry mentioned the CFO submits the certification to and it's got to be a majority of the full governing body. Once approved, the special emergency may be raised over a 5-year period with no appropriation required in 2021, or rather 1/5 of the amount budgeted in 2022 to 2026. So it's basically a 6-year period.
Yeah, if I can jump in on that.
Sure, Jerry.
That's where the spending becomes kind of critical. I mentioned earlier that, all right, we have a regular emergency that we're spending the money, and as the grants come in, it's reclassified to the grants. In my case, it's $3 million. We've gone as high as about 2.3 million. We're down to about 1.2 as we've reclassified to the recent grants that come in. As we all know, a regular emergency, you've got to raise that in the next year's budget, in the 21 budget. So by converting that emergency from the spring into this special emergency, it allows us to basically skip the funding of it in the 21 budget and start funding it in 22. As Joe mentioned earlier, with the amount of grants that are coming in, hopefully spending doesn't become a problem for us, but I can't see clearing out that emergency before December 31st into grants. So this 5 years over 6 allows us the whole year of 21 to reallocate whatever the net expenses are, to allocate the expenses to the grants. And then if anything is not covered by the grants, the balance then would be covered in the next 5 years. So it does take a significant impact away from the taxpayers by doing that. This is my favorite part of this local finance notice, is being able to spread that 5 over 6 years, because it gives us time to get everything done.
Yeah.
When we were practicing this yesterday, we had talked about that the local finance notice specifically mentions that this deferred charge will not be used as against fund balance, which is contrary to what we've always done. Were you able to clarify that?
I was not.
Okay. I know we're going to reach out. Someone's going to reach out to the division.
I spoke to, again, if you're putting this together on a county level, you need to get your auditors involved. So I had a brief conversation with our auditors, and our game plan is to issue these notes, the beginning of the year in January. We need to, once we get our final revenues, we may have to go back and cancel. Again, if we're cancel, if there's a little bit of an excess, we don't need as much, we have to cancel that emergency, and then we issue the notes, and then we can go back, since it's, if we do this in January, we can go back and that defer, according to our auditors, and that deferred charge would not take away from the cash surplus calculation on the AFS. So, but it is, as John said, specifically on the finance notice, this deferred charge will not be a deduction from your surplus. So. Again, there is a 10-year, again, you can apply to the local finance board if you want to go to 10 years. Again, there has to be a special circumstance for that.
And Melanie, on another call last week, the director had given some guidance on that if you're going to go in front of the local finance board, they're looking for at least a $50 per residential property impact. If you're less than that, they're probably not going to approve it. So basically, they're not going to, that's the threshold. If it's going to be a significant impact, you can go beyond the 5 years for up to 10, based on the case you can make to the local finance board. And that's the magic number, the impact of more than $50.
More than $50.
Average residential property taxpayer. That was Melanie last week.
That's a good point, Jerry. If we do receive any offsetting revenues from the federal government or state, that could be applied against revenue. Right now, CARES, you cannot use CARES funding for revenue losses. But again, after the election, who knows? That might change, because I know Pelosi's big on that for helping local governments offset their revenue losses. So I guess that's something we have to wait till after the election. Special, again, we talked about, I guess we talked about the deferred charge. Again, the journal entry, I think John said the journal entry is you're debiting the deferred charge and you're crediting operations. So, which is a little bit different than we're used to.
A lot different than we're used to, right? We're normally an appropriation that we can track against. Here, we're just plugging it right to operations.
Yeah, we plug it right. Yeah, it's a little bit different. So.
To me, it's crazy because if we're supposed to reconcile in the next year, if you overestimated, wouldn't it make more sense to have an appropriation where you can figure out what you charged?
Right. I think though, if you overestimate, you have to cancel that. I guess we'd have to cancel it in the new year.
So theoretically, you can cause a deficit in operations in the next year by correcting it.
So that's something we have to, monitor. All right, Ange, let's go to the next one. Okay, so again, this, I'm not sure everyone knows this, but Moody's came out on September 8th, and they're very bullish on this. And again, I'll just read quickly, they think it's an effective tool. So it's just read a quick deficit finance, which has not previously permitted in New Jersey, will be a powerful tool for municipalities to deal with the revenue losses and exceptional expenditures caused by the pandemic. So Moody's, again, this is a good thing. I think this gives us cover, and it makes sense on from a ratings perspective, because they want to make sure that the fund balance is protected.
I can jump in there.
Yeah,
We actually had one of our larger investors, a large brokerage firm, huge brokerage firm. They bought our jail money, 65 million, the tech 70 million. I mean, they're well over 100, 150 million into our debt. So they have a big interest in what we're doing. So I get calls from them a lot. When these bills were being proposed back in the spring, they were incredibly happy about it. I mean, it's very important. The investors actually were less concerned about fund balance and deficits and operations. What they wanted to know is, you have the cash. Are your the tax collections, are you going to come in? And when this was proposed to authorize notes to cover revenue deficits and so on, it was very exciting to them. They were very, very happy to hear this. And when those, it's important for Standard & Poor's and Moody's to be happy, because they're giving you your credit rating. But, the reality is the investors are the ones putting an interest rate in there and actually buying your bonds and notes. So making them happy was really good to hear. And supportive of what we're doing here with this.
Yeah, that's an excellent point. Yeah, I mean, listen, I think this is a great tool, and I'm not sure how many counties are going to. I mean, we're Bergen. We're definitely going to be taking advantage of this. The way I look at it, I'm sure every county has some revenue losses. Why leave that money on the table? Augment, stabilize your fund balance. Again, because we don't know what's going to happen in the future. Who knows? Get that fund balance up to where it was, and again, both ratings. Moody's is bullish on it, so I think it's a win-win. Let's go on to the next slide, Angela. Okay, so again, step one, forecasting your revenues. Again, I'm just this is an example I put together. We have the county of Mayberry, not in New Jersey.
My county.
Figured that's so. Again, I'm sure I highlighted areas where I think counties are going to have some issues. Motor vehicle fines or surpluses. Those are the Chapter 39 splits that you get from the towns. If you bring that into revenue, again, there's no one on the road and during this pandemic, so I'm not sure we're going to receive any revenues. So that might be a $1.3 million negative variance. Realty transfer fees, not as bad as I thought. At least, you know, it looks like everyone's escaping New York City and coming into New Jersey. So there is a lot of real estate transactions. So I'm not sure on how that works county by county. Again, public safety fees and most of that is, that could be if you have a tuition-based public safety system. We have an academy up there, so obviously no one's really taking some classes up there, so we're seeing. The big revenue loss, and I'm sure every county has this issue, is the foreclosure sheriff's revenue, the commission fees. That is a big, again, there is, the governor put hold on any type of foreclosures. So for us, that's a big revenue loss. The other is parking, our Justice Center parking. The courts are closed, so no one's putting money in the mirror and so forth. Let's go on to the next one, Ange. Okay. Health fees, and if you have a nursing home, I'm not sure, not too many counties have nursing homes. We do. Again, nursing home revenues are down, you know, population is down and so forth. No one is, there's no new residents going into nursing homes because of the obvious pandemic. Park fees, I'm not sure on counties, you know, their park systems, I'm sure with the stay-at-home orders and just the social distance, there's not a lot of people out and about. And golf courses, again, again, you're probably going to feel it on the county level. Central Municipal Court, we have in the county, obviously there's not any, because of lack of activity and there is, you know, no ticketing going on. So again, in this example, where I mean, we do have some positives, but the net is, I just want to, if we go down to the last column, all the way down in the bottom, you'll see in red, you'll see 8,039,000. Okay, I think there's a 892,73. That is the negative on the budgeted revenues. And you know, again, I know on our county side, we had introduced our budget late, and we reduced our revenue anticipation. So again, you know, this would have been higher if we didn't reduce our revenue anticipation.
Yeah. Now, I jump in. So we obviously, you know, the questions are being asked: investors, rating agencies, governing body, you name it. How we doing? How we doing for revenue? I mean, even in a good year, we should be doing this at least monthly. Now, I got to admit, I don't do a formal spreadsheet like this and do it in a real pretty form because I'm not sharing it with anyone. I want to know where we stand. So I got a calculator taped to my desk, and I rip it off every month and put a new one, and really just take the GL revenue, you know, where we are today, and then look through. Okay, go through each line item, and it put, you know, okay, we're going to get interest. All right, another 40,000 in another 3 months. Boom, boom, boom. Clerks, what do we, you know, and just plug it in the calculator. When I'm done, here's where we are. I'm looking at, I've got a much smaller budget, but I'm still looking at $1.5 million in a revenue deficit. I mean, compare budget size is pretty much the same as what we have on here when we scale it down. But we also, again, we're turning in the appropriation reserves from last year, so we don't want to forget about that. So what this is doing, I mean, hopefully, most of the counties aren't going to have a true deficit, but this should allow us to be able to have the surplus we need to anticipate a similar amount next year.
Exactly. You hit it right on the head, Jerry. So are you, just a question for you, Jerry, are you, is that your plan to do this this bonding or this?
I am not.
You're not, okay.
Yeah, we have 9 million rolling in from appropriation reserves for 2019 that offsets the 1.5 million revenue deficit. So that's a net of 7.5 million in operations, and I anticipated 7.5 million. So we're going to end the year with exactly the same amount of surplus or fund balance, before John corrects me, that we started the year. So really, this is designed to replace that fund balance for those who don't have sufficient funding to anticipate the same amount next year. So I'm looking at it. I'm looking at it on the expense side as a safety net to cover the expenditures that either are not covered by grants or timing until they are covered by the grants.
Understood. Yeah, that's a good point. It all, like I said, it goes back to the old. There's never enough fund balance. So again, it sounds like you have your reserves are decent. And but again, I'll give you an example. The example I'm going to share. If you don't have, again, if you see that it is an impact, again, you could use this tool. Why don't we go on to the next the calculations, Angela? Okay. So in this example, if this county of Mayberry, okay, so if this county started with a $50 million fund balance, they utilized roughly 50% as revenue in their current fund budget. The subtotal is 25 million. Again, if the deficit in that revenue, which we discussed, the 8,039,000, that is a negative. Again, there's two columns. The first column is utilizing the special emergency. The second column is no, not utilizing it. So that's why you see 9.5 million in there utilizing the CARB and zero in the other column. And again, just some strategies of what's the calculation of fund balance. Again, your non-budget revenues, that's a plus. Any 19 appropriation lapses, that's a plus. And again, and this gap we talked a little bit about here. Again, this is part of your strategy. If you need, if you have any 2020, if you have extra debt, that automatically cancels into the fund balance. And if there's any 2020 appropriations that you can cancel, you feel comfortable, that could be a strategy to augment your fund balance. Same thing with contracts cancellations. So the number I come down to is how much, I used 25 million in my budget. How much did I regenerate? So I want to regenerate at least 25 million because next year I want to at least try to use 25 million in my fund balance so that the goal is to regenerate your surplus. If I don't have any CARB bonds, look at that, $15 million. So I cannot, a good CFO is not in a good conscience going to use keep the fund balance in 2021 at 25 million when the regeneration is only at 15 million.
You won't get through too many more years at that pace.
At that pace. So again, you're projected. So in this example, this county, the fund balance is back at 50 million, the same as last year, the beginning of the year. With no CARBs, it's at 40. Again, the preliminary, go down to that line where it says 2020 preliminary surplus revenue utilization. Again, this county could maybe comfortably say, all right, I'm going to use the same 25 million. Again, on the other side, if you don't do it, it goes down to 15 million. So you have a $10 million revenue shortfall. Okay, and in this example, the 2% on the tax levy example was 400 million. That's $8 million. So you could only raise, generally an $8 million without your exceptions, of course. 8 million, but you're going to start with a $10 million hole. So you're going to have some cap issues too if this county doesn't, utilize this special emergency. John or Jerry, any comments to that?
Yeah, I mean, we looked at the revenue deficits, and in this example you had, it was maxed at 8 million, which in this example is a little bit short of what you needed. but it could go the other way where your revenue deficit's a little more than what's needed. So we have to look at both revenue deficits and your fund balance position to see what's a proper amount. We're going to start picking up the pace.
Yeah. Let's just go. My last slide is.
If we don't, hey guys, I know you want to pick up the pace, but we do have a question.
Okay.
That I'd like to. It's from David Morrow. I apologize if I'm saying your name incorrectly. It's a two-part question. Are you calculating revenue loss percentage during the lockdown months only, March to the current month, or doing a year-to-date average to budget for 2021? And then the second part of that is, how are you budgeting for 2021? Worst case scenario, assuming lockdowns last the entire year.
All right. The first one is the easier one. It's a 1 year budget. It's a 1 year budget. We're looking at our projected 21 for the 12th aggregate month. Or I'm sorry, 2020 for the 12th aggregate months. So that's, you had a couple good months and then this hit. For 2021, as we mentioned, we are allowed to go up to the 3-year average for 17, 18, 19. Allowed to. Interest, for example, I know there's snowball's chance in hell that I'm going to get 2020's number in 2021, let alone the 3-year average. So when I know what the number is going to be, I'm not going to artificially inflate the amount anticipated. I'm going to use a realistic amount. Now, as far as anticipating when the pandemic's going to end, I'm hoping for the best, budgeting conservatively. It comes to a balancing act. I don't want to anticipate more than I know I'm going to get. If I know it's going to be less, it's going to be less. If not, I mean, we just have to give educated guesses. Sheriff's fees, real estate transaction fees. The person asking the question has a very good point. If we know they're not going to hit the 3-year average, we need to try to be realistic in what we're doing.
Exactly. I think if we go to the next slide, I think that might answer the question, Angela. So the next slide. So when this comes right from the form on the website for special emergency. So the blue column is the 3-year average for the special emergency, and that's 19 to 17. So the motor vehicle surplus, we're projecting 0 in this example for 2020. However, for the purpose of the emergency, we can use $1.8 million, 1.8. That's what you can go up to. And then the next column, which I put that in, it's not on the form, that's actually the 2020 anticipated budget. So, so using this example, we're using 20 to 18. So I could legally, for motor vehicle surplus in 2021, to answer the question, I can go up to 1.266. But again, that's the max. But again, I have to look at what's going on. If there's still activity, to Jerry's point, you know what, we may anticipate a much lower amount in our budget.
And I want to give the division a little bit of credit here too. Joe mentioned earlier in the presentation the 2 different 3-year averages. If you're looking at the deficit in 2020, then it's the 19, 18, 17 average, because you didn't hit what you expected to hit in 20. And what the division has done for 21 is included the 2020 revenues in that 3-year calculation, knowing that there's a significant decrease in 2020. So they're forcing that number down a little bit in 21. They're at least making us look at that as part of the trend.
Exactly. So these revenues here, these are the COVID revenues. So if you look at the total projected of the COVID revenue, the revenues affected by COVID is 27,052,000. Okay. Again, the 3-year average is 41 million. So the special emergency, okay, theoretically can be the $14 million, but you know, but again, I don't advise to do that. Again, if you look at, looking at your fund balance, if the 9 million or the 10 million is your number, you would go up to that. So just to recap, in 2020, the COVID revenues are 27,052. For the 2021 budget, okay, legally, okay, you could go up to in the last column, those revenues could total 37,258 on that. Again, we have to look at the times and see what's going on. Hopefully things are back to normal and we'll see some jumps next year.
Next.
Any comments, John, or?
No, you know what's funny is in preparing for this, we were concerned that we didn't have enough material, but we now have 8 minutes left and 30 slides.
Oh, boy.
27
Yeah.
slides to cover.
John
So,
once told me I could.
Why don't you guys, why don't you jump in then and go through the, what do you want to cover, John and Jeff?
Let's go to the next slide. Let's get moving.
Yeah.
One more,
So-
if you don't mind, Angela. So, I mean, cash flows, we can paraphrase this. I mean, obviously we need to identify what's at risk, what's not at risk. The GFOA conference, GFOA of New Jersey conference, we had Shane Cavanaugh from GFOA National talk about, and we've all got our own tools, but they actually showed us a tool that was really cool. It grafted, it had a great foundation for putting all your information in. I shared it with Joe. We were hoping to have it done for this, but we actually put a lot of effort into getting this session together. But essentially with cash flows is you're predicting, you know, what your cash position is going to be in your general ledger, in your cash accounts. Jerry, you want to talk about your consolidated approach?
Sure. So, what we've done in Cumberland is, you've got a lot of money. You've got trust fund, except obviously the prosecutor needs to have their own trust fund. But what we've done is create a single account. We got a bank account for payroll and a bank account for all other operations. What's that? I mean, people talk about cash flows. Well, okay, you could borrow from yourself. You interfund. Well, I've always interfund. We have one bank account. All of our trust funds, again, except the prosecutor, all the capital funds. We do the books for our health board, which is a separate autonomous taxing entity. The library, you name it. Everything goes through one bank account, and there's just an allocation on the general ledger as to who owns each portion of that cash. That's allowed us to really have no cash flow issues. In addition, it allows us to be, our sponsors here, Investors Bank, is our bank. We bid it every 3 years with 3-year contract. The banks are much more aggressive in their proposals when you make it easier for them. I went into Little Cinnaminson with a $15 million budget, and there were 30-some bank accounts. My head exploded, put it back, closed all the accounts. Cash flow became much easier. It really does help. Then you're just looking at, all right, every 3 months we have a tax levy, and what happens in the 2 months in between. You can take a much broader look at your cash flow than trying to predict cash flows in 10, 15, 30 different bank accounts. Been effective for me.
All right, next slide. So the next slide just talks about how to do it. It's setting up like your checkbook, the register you have. It's you figure out what your beginning balance is, you have all your ins and your outs, and it gives you the ending balance. And it should allow you to predict, and I guess it depends upon your frequency, whether or not you're doing it daily, weekly, monthly, just to identify where your cash hardships might be. If you go to the next slide. So we talked about different areas of different revenue streams, you know, and Jerry, I think you and Joe want to talk more about this until we get the pilots, and then I'll chime in.
Well, we mentioned quite, Joe hit this already in the last slide, so we really don't want to spend too much time. But we all know, obviously the sheriff's foreclosure fees, with a moratorium on foreclosures, interest earnings. In my case, I went from $1.5 million down to probably hitting about 700,000 this year, and realistically 500,000 last year. So $1 million hit there, $1 million in sheriff, $1 million in the we have a couple areas that clerk's fees listed that are really hit. I mean, it's not rocket science. We know where the monies are. We know where the shortfall is. It's out of our control. John, pilots.
So the pilots, obviously the county is entitled to the 5% depending upon when the agreement was executed. If it's a residential unit, that's usually based upon a percentage of gross income. We know of a lot of people that stop paying their rent because they could and they won't get evicted. I've seen a couple pilots that are done as a revenue sharing arrangement, such as a mall. Malls have nobody occupy or very little for that period of time. So those revenues are in a tank. So I think we need to have our eyes open that it's not just a guaranteed that 5%, there's going to be a compromise on those as well. The benefit that we talked about is that obviously from the property taxes coming in, the counties are guaranteed 100%.
Shared service is pretty much guaranteed also. In our case, most of the shared services are amongst various county agencies. We've got quite a few agreements with the county college, which is now Gloucester and Cumberland combined. As I mentioned in the cash flow, we have a shared service agreement with the Board of Health. There's a separate Board of Health tax. We do all their administration for an administrative fee. But the list goes on. You're doing shared services to save costs on one side and produce a revenue on the other. So they're really not at risk because, if you're on the receiving end, the person paying you, is paying you less than they would to do it themselves. So we don't see that as an at-risk item. Next slide.
So this one I need to update. I told Jerry and Joe last night that I would make sure that the rates were current. That the current target rate of the Fed's funds rate is 0 to 25 basis points, which is nothing. And actually that's dipped again. 1 month ago it was 25 basis points, and 1 year ago it was 2.0 or 200 basis points. So we've seen that dip. The 1-year Treasuries yields are right now trending, or they're trading at 12 basis points. So we can see that the market continues to decline. I looked at the yield curve on those, and it's essentially flat unless you go out for a 30-year investment, which I don't think anybody's willing to tie that up. And even if you go 30 years, I think I was only getting 1.25%.
Yeah.
So we know that there's no income from investments right now.
One of the attendees asked the question, about the projecting the revenues for 21. We have a 5-year projection. I'm projecting that interest is going to be down for 21, 22, and then start the recovery midway through 23. Obviously, 23 can be adjusted next year if things start to get better faster. But that's the assumption I'm using on the interest based on what I'm hearing in the news about the Fed's position on that.
There was one question about getting the PowerPoint slides after the presentation is done. John, are we going to make those available to everyone?
Yes, as long as you guys are okay with it, we'll make sure to make that available to everyone. It's a lot of great information.
Okay, not a problem at all. Next slide, please. This is really just an oversimplified example of what you can do on a monthly basis with your ins and outs. Obviously, it's exaggerated and oversimplified. So I don't think we need to spend any time on this one. Next slide. Thank you. So the important thing is here is if you identify that deficit, what are your funding tools? We have the ability to use tax anticipation notes. We can look at what we're spending our money on. I think the last thing that we want to do is furloughs or layoff plans, but it is an option. A lot of those letters that we send out in the fall, hey, if you don't need to spend your money, don't spend it. So you delay that expense. A lot of it's just common sense. We hate to delay funding of capital improvements, but that was early on when this thing first hit. This is one of the suggestions is just stall your capital plans, see what happens. Yeah. You don't starve yourself of cash. And obviously just anything that's not essential, identify those.
Well, one of the things we did is you stall the projects themselves to keep your cash flow in the middle of the crisis, but we actually accelerated the note issue. The interest rates are low, so finance it now and do it next year. That picks up a lot of cash real quick. course,
You
you
can-
got your arbitrage situation where you may have to give some of that back to the IRS, but that's a couple of years down the road.
So if we go next slide. Next one again. And one more. So we know from the municipal bond market in the very beginning of the pandemic that the market was in a state of crisis or panic. And then the Fed started to flood the market with the 2.5 trillion in TANs. Then they went back for 500 billion to buy notes. It wasn't intended to be a long-term solution. It was just intended to stabilize that market. They talked about the municipal liquidity facility, which I know the state of New Jersey was putting together. The iBank came out and they offered $50 million, but when you think about it, $50 million would last 5 seconds in our market because it would get consumed. Plus, you had to be a member. By the time you met all that criteria, it was something that was so tightly written that nobody would really qualify for, or it didn't make much of a difference. The one that's out there that you guys may or may not have been aware of is the MEL form, what's called the Joint Cash Management Investment Program, which pooled all of the joint insurance funds monies together, which gave us $500 million to go into the market and to start buying municipal debt. In the beginning, I'm the investment chair for the MEL. We focused on just buying our own members' debt. We didn't buy anybody that was not a member, was not even considered in the beginning. We've since loosened that up. But what we found is we corrected the market. When people were coming in and gouging in the beginning, we were actually correcting that trend and keeping it down to a fair price. So that's just something that was out there. And we can't forget that the governor's special bill allowed him to borrow $5 billion, which, like the car bonds, he gets no oversight and we get tons of oversight. So next 2 slides. Jerry?
Okay, we talked and mentioned briefly about doing the emergency so that everything comes out of a single pot. Of course, when you're tracking monies in health board and different areas, this is pretty important to be able to have the technology be your friend. So, for example, on the payroll, when the emergency was at its peak, half of our employees were being paid to stay at home and do nothing, just stay away. So we created a COVID code for that because we need to know how much that had cost us. Those who are coming in and working, especially the health board, the people doing the testing sites, the sheriff's officers that were guarding the testing sites, those directly involved in that kind of stuff. We had a payroll earnings code that says, all right, this is direct COVID time. On the vendor side, there's, as it says on the slide, MSI and Edmunds both have commodity codes, project codes. You assign these codes to the purchase orders, and then you go to document your FEMA, CARES, you name it. You run codes based on your earnings code and payroll and your commodity codes over in the vendor file, and there you go. There's your documentation. Use technology to be your friend to help you out when you're actually substantiating these expenses. You get all this money from the grants. They want to know how you spent it. In our case, we have that emergency, and then, as I said earlier, as we get a grant, we're reclassifying those expenses. We're actually pulling them out of the one pot and into the other pot, which is also very effective in tracking. So just be prepared to if you can't substantiate what you've spent, you're not going to get the grant. You want to make sure that every money that's been approved for you, you actually get. You have to be able to prove you've spent it properly.
Yeah, it's I just want to, it's very important because again, especially if you're one of the counties that got the advanced money from CARES, you need to have documentation. I hope everyone put their payroll system codes in there because if you can't substantiate that, guess what? That money's got to go back to the federal government. So
you don't want to give any money back.
So you don't want to do that. So that's important.
Next slide. All right, so Joe just mentioned the 9 counties getting the original advance. That's the direct funding to the 9 large counties. We now have an MOA with the governor, where the governor is passing down some of the state's monies for this, same grant. Federal government said, all right, we're only dealing with populations over 500,000. So they went direct to those counties and direct to the state. And it was up to the state to then spread the money to us smaller entities. So we're working through that now. And that's used to cover, our FEMA money, we've got 25% match, so we can use this to cover that. The PPE, our emergency management has a concern that FEMA is not going to cover PPE and going to harass us about whether we're stockpiling it or really used it or whatever. So as we go through scrutiny with FEMA, we can move some of that to this program. And that's where we get into a little bit of a challenge with the deadlines. We talked earlier about deadlines, December and January, and get this money spent while we wait for FEMA to decide whether they're going to reimburse us. So we're trying to fast track our FEMA stuff and at least get some sort of evaluations out of them. And those things that are at higher risk, we're moving that out and putting it into the new grant. The new grant is supposed to fund anything not covered by FEMA. So it's an interesting balancing act that we're doing with that. So next. Okay, here are those key dates for the pass-through CRF funding. We did in Cumberland County, we did our resolution last night for application and maximum funding need. By December 10th, we need to submit our expenditure reports and have everything that's going to be charged against this encumbered. So, anything that's already been done and can be used is a lot easier. So not only is it needed to be encumbered by December 10th, but you need to have your payment out by January 30th, and you can't pay unless services or goods have been received. So this timing becomes a big challenge. On a call last week with the director, someone asked, well, how am I going to get that done by that time? She suggested you do a special meeting if you're freeholders. You want the money, they do a special meeting. So we need to have that resolution application in by November 10th. Okay. The revenue shortfalls are not eligible grant expenses. It's on the expense side, not the revenue side. So, that's where we have to have multiple tools. And we talked about the CARB bonds as those tools if you have issues with revenue shortfalls. All right. The last one on the substantially dedicated, that ties in with my suggestion on the payroll codes. So you go back into your payroll system, do your earnings codes for those who were directly involved in the emergency, and there you go. You get that reimbursement. Those costs have already been incurred. FEMA will only cover overtime costs. This will cover regular costs. As long as it was a direct service for the COVID. So your testing sites and those type of things can help you get money back for that. All right, next slide. Set up chapter 159 at the bottom in big bold. So the division has basically taken no position on this, but then recommended reimbursing your expenses. You really have two options. Chapter 159, for those who don't know, that's your public laws of 1960 something chapter law. It's a budget amendment. So you're amending your budget to bring in a new item of revenue offset by the appropriation. So, as I've said several times already, it's much easier to track this stuff if you set up the appropriation. So when we apply for FEMA, our application for FEMA has identified a list of expenses. So when we apply for FEMA, I'm setting up the 159. So I'm anticipating that, you know, that 75% revenue and reclassifying those expenses against the against that grant. So, you know, there's so many grants out there. If you're not managing them orderly, your head's going to explode. It's just, you know, we got money here, money there, money there. So, so as you get a different grant award, you're going to amend your budget to set up that appropriation, because otherwise you're not going to be able to track it. Again, the division will allow you to do direct expenses. I'm sorry, direct reimbursements. So you get a grant, you reimburse your health board, you reimburse your sheriff's office, you reimburse wherever the expenses were. And then God help you when the audit comes in and you're trying to do the single audit schedules, your grant schedules for audit. You're going to have to identify that and find that you're tracking them all over again. So do the chapter 159. Let's go to the next slide. That has something on the yeah, some allowable costs. I mean, this is all common sense things. How do you use your grant? You got to use it for things that are appropriate, things you've spent for the grant funds. Let's go to the next page in the matter of time. It's 12 after. This was, we were speculating that this was Bill Gates involved somehow. I mean, this is a 501c3 that offered up a lot of money, and these were advanced. It has here Bergen was 2.6. Again, we're a little bit smaller. We got about 900,000. This allowed us to cover a lot of those excess costs for the elections. The elections, as we all know, are costing us a fortune, and where are we getting the money? It's not FEMA, it's not CARES, and so this has been a big help in covering. Go to the next slide. I think this has some of the uses.
Yeah.
So yeah, so this is helping us cover. I mean, in our case, we're using it to cover the additional printing of ballots, because, you know, we got to have paper ballots. That was around $500,000. We've hired 150 workers that, you know, we used to have just a handful of poll workers. Now we have workers coming in for a 6 or 8 week period. And it's not like, it's not casual workers. These guys are working 60-hour weeks. I had to approve yesterday time and a half, because we said, oh, it's a flat $15 an hour. That's it. Well, you know, fair labor standards, you go over 40 hours, it doesn't matter that they're casual workers. They're getting time and a half. So this grant has been wonderful in covering those expenses that obviously were not part of our original budget as we contemplated that it would be. So, Joe, do you want to comment on this?
Yeah, I just wanted to say, like I said, tracking the costs. We have also in here, I'm charging, if you have the sheriff's department protecting any of the drop boxes, or kind of supervise or watching over the ballot counters. Again, you need to communicate with the sheriff's office, and you need to get all that information, establish your pay codes. That's what we did. We established actually a special pay code for the for the election grants on that. So important, try to capture all those costs, besides obviously the balloting. That's any other promotional. You know, we did a commercial, or you know, just explaining you know, how to vote and what's going on. So that's you know, that's perfectly, in my opinion, okay to charge the grant for any type of commercials advising the public how to vote under these conditions. And just want to mention is that the January 31st, there is a deadline of the expenditure report due to this organization, the CTCO.
They advanced it. If you don't spend it, you're giving it back.
You're going to give it back, yes.
Next slide. We're like way out of time. Okay, good. We're done.
We're done.
Well, the point of this one is that we're all managing and monitoring a million different metrics and measurements. You know, Jerry's not so formal with his revenue. Joe is. So I think we've all developed some sort of tool or dashboard in order to track what's going on. I think that, whatever you can do to manage it, it's better than not at all. Do you want to open up for questions?
Yeah, if anyone has any questions, again, please type them in the question and answer box. If you do not, if you think of one after, you can certainly send us an email and I will get it to Jerry, Joe, and John. So it doesn't look like we have any questions because it was a very thorough and terrific workshop presentation. So I appreciate it. I appreciate all the time and effort that you put into preparing for this. I owe you big time for doing it. And just again, want to thank you, gentlemen, for your hard work and for being just honestly outstanding public servants in the great work that you do. So thank you, gentlemen. I appreciate it. Thanks
Thank
everyone else for joining us. And I hope to see you next week for our workshop on human services and social services. So thank you and have a great day.
Great.
Thanks, you too.
Thank you. Thank you, John.
All right, guys.
Thank you, everybody.
We have a question.
Oh, we do have a question.
Just a thank you.
It was a thank you all. Thank you, Debbie.
Yeah, they're just thank yous.
And we will send the PowerPoint presentations if you haven't hung up yet. Thanks.
All right.
Take care.